If you want to build real wealth, you've asked the question, should you put your money in the stock market or buy real estate? Almost instantly, you're hit with two completely different directions. One camp swears that buying index funds is the only logical choice, while the other insists physical property is the only true way to get rich. This chart shows the trap most people fall into when trying to settle the debate. They look at the stock market's historical return of 10% a year and compare it directly to average housing appreciation of 4%. But doing this is literally comparing apples to oranges. Looking strictly at these two numbers, the stock market looks like the obvious winner, but the mechanics of acquiring these assets are entirely different. When you buy stocks, you use your own raw cash. When you buy a house, you use a large chunk of a bank's money. To figure out how fast you can actually grow your net worth, you need three things: capital, your rate of return, and crucially, time. Neither asset is magically faster in a vacuum. To determine which path is faster, we have to evaluate the specific mechanics that dictate growth: leverage, liquidity, and the physical reality of managing the asset. Making the right choice means finding the mechanism that mathematically aligns with your current bank balance and your lifestyle. Let's look at the stock market first. When you buy a share, you're buying a fractional ownership stake in a real company. It's a highly liquid, fast-moving environment where you can buy and sell pieces of thousands of businesses instantly, directly from your phone. The most reliable way to succeed here doesn't involve day trading. It involves consistently investing moderate chunks of your own cash into diversified index funds, like the S&P 500, month after month, year after year. This graph shows the true engine behind stock market wealth: compound interest. If you put $10,000 in the market and make a 10% return, you earn $1,000. But as you leave that money alone, you start earning interest on your previous interest. For the first few years, it feels agonizingly slow. Then, eventually, the math begins to snowball into massive sums. The trade-off for that exponential growth is short-term pain. The stock market is volatile. You will have to stomach sudden drops, economic recessions, and systemic crashes. It requires the psychological fortitude to watch your portfolio bleed red and do absolutely nothing. But the ultimate benefit to that strategy is total passivity. Index funds require exactly zero physical labor. There are no tenants to screen, no broken toilets to fix, and no contractors to manage. Stocks are the ultimate hands-off compounding machine. They offer a completely stress-free operational lifestyle, provided you have the decades of patience required to let the math do its job. Real estate operates under completely different rules. We are moving from digital shares into a physical, highly localized, and incredibly slow-moving asset class. Since homes generally only appreciate slightly above the rate of inflation, physical property needs a specific financial mechanism to compete with the stock market. That mechanism is leverage, using other people's money. This diagram shows how a standard mortgage works. To buy a $500,000 property, you don't need $500,000 in cash. You put down 20%, $100,000, and the bank covers the remaining 80%. You now fully control a $500,000 asset. If that $500,000 house goes up by just 4% in a year, the property gains $20,000 in value. But remember, you only invested $100,000 of your own money. That $20,000 gain represents a 20% return on your initial cash. You are getting paid appreciation on the bank's money. On top of that appreciation, if you rent the property out, a tenant is actively paying down your loan balance every month, while hopefully providing some extra cash flow into your pocket. But leverage cuts both ways. If the property's value drops by just 10%, you lose $50,000 of equity. Half of your initial cash is gone. If the market dips too far and you are over-leveraged, your investment can be wiped out completely. Debt and rental income act as massive accelerators, giving real estate the power to outpace stocks in the short term. But that same debt turns your investment into a high-stakes financial tightrope. There is also a massive difference in friction. You can buy $10,000 worth of index funds from your couch for a $5 fee. Buying a property takes 30 to 60 days of heavy paperwork and negotiation, and that process isn't cheap. Right out of the gate, you instantly lose thousands of dollars of your capital to closing costs, legal fees, appraisals, and agent commissions. People often call rental income passive, but that's a myth. Physical assets decay. You have to handle emergency repairs, deal with vacant units, and navigate local tenancy laws. It is very much a part-time job. Real estate has a major structural advantage to offset this work: massive tax write-offs. Depreciation and mortgage interest deductions can legally shield your rental income, whereas every dollar you gain selling a stock in a standard account is taxable. But if an emergency hits and you need cash immediately, the two assets split completely. You can liquidate your stock portfolio and have the money in your bank account in 2 days. Selling a house to access your equity can trap your capital for months. Ultimately, real estate is an active business with high barriers to entry and massive tax perks. Stocks offer true passivity and deep liquidity, but they lack those same built-in tax loopholes. With the mechanics out of the way, deciding which asset is faster comes down to diagnosing your specific life constraints. This flowchart isolates the two variables that actually matter: how much starting capital you have and how much time you are willing to spend managing your money. If you have less than $10,000 to start and you want a stress-free existence where you can just set it and forget it, you fit the lazy investor profile. Your fastest path to wealth is buying fractional shares of index funds and letting compounding do the heavy lifting over time. If you have a larger chunk of cash, say $50,000, and you don't mind fixing toilets and negotiating leases, you fit the hustler profile. You can buy a multi-unit property, live in one half while renting out the other, and dramatically force the value up through your own sweat equity. If your profile is simply wanting to get rich in the next 2 years, neither of these assets will work for you. Building true, resilient wealth takes a minimum of 5 to 10 years. Anything faster is just gambling. Choosing the right asset class has almost nothing to do with predicting macroeconomic trends. It's about accurately diagnosing your own emotional risk tolerance and the reality of your current bank account. However, the most financially successful people eventually stop choosing sides. Instead, they use a hybrid strategy, moving seamlessly between both assets at different stages of their lives. In phase 1, early in your career, you put 100% of your investments into stocks. You keep your cash liquid, avoid the physical anchors of property maintenance, and let compounding build your foundational capital base. In phase 2, once you have significant equity in the market, you pivot. You can sell a portion of those stocks or borrow against them to secure a 20% down payment on a rental property. You use your digital wealth to buy a physical, cash-flowing asset. Finally, in phase 3, you take the monthly rent checks generated by your real estate and pump that cash straight back into dividend-paying stocks. You create a self-sustaining wealth snowball where each asset feeds the other. No matter which asset you prioritize, the actual engine of your wealth isn't the percentage of your return, it's the percentage of your income you actually keep. Your savings rate, the gap between what you earn and what you spend, is the ultimate accelerator of your net worth. Investing 50% of your income into an average asset builds wealth faster than investing 10% into the perfect one. Stocks can make you rich over decades. Real estate can make you rich in cycles, but it is your daily saving habits that determine if you ever get rich at all.